right, Shawn, welcome to our latest fireside chat. Appreciate the time. We're gonna get into it here in just a minute, but I wanted to just highlight our friend Jim Nittle's sick today, so it's just you and we're left to carry the ball here without our normal facilitators. So we're gonna try to do our best, but we need to keep it inside the lines and keep it tight. So with that,
Speedy recovery, Jim.
yeah, let's hopefully he's back for our next month's installment. But macro and Q4 earnings, what are you seeing? Give us the good and the bad.
Yeah, Bill, for the most part, the macro has been much stronger than anticipated. If we look back to a year ago, expectations were not for GDP to be in the high 2% range that we saw. We ended up 2024 at 2.8%. That was against 2.9% in 2023. The expectations were for 2% or even lower. There was talk that the Fed would have to come in, would have to lower interest rates, prop up the economy. We did not see any of that last year. And that allowed markets to kind of move higher. It also allowed earnings, which we'll get to in a minute, to really move higher. So overall, I think I wouldn't say the economy's strong. I would say it's solid. I would say it's probably very solid. We're looking for kind of 2 to 2.5%, maybe 3% in Q1, kind of 2.5% for the year. I just looked at the Atlanta Fed GDP Now forecast. They're at 2.3% for Q1. A lot of expectations are in that 2.3 to 2.7 range. So I think that's what we're hearing too when we listen to companies on quarterly earnings calls and whatnot, is they're seeing a solid consumer. Some are saying a strong consumer, and that's the consumer that's kept us up all along. So the consumer continues to provide tailwinds to the economy as a whole. And if you add in some of the regulation coming off that we're going to start to see in the new administration, I think that's another tailwind that will play out probably in the second half of the year more so and into 26, but it's something that we should look forward to.
Thanks, Shawn. That's good context. With that, what are we? There's a lot of talk right now. There's an awful lot coming out of Washington. I think we can all agree on that. It's been at breakneck speed. But let's talk specifically about the economic stuff. What are we seeing here? Fed, tariffs. What do we think we're going to see as potential headwinds? And how do we manage through this?
Yeah, so I think from the Fed, our thought all along, and we've gravitated toward this because we were in the camp when they started to lower rates in September that we would see probably 100 bips of easing in 2025. That's not going to be the case. The economy is too strong, performing too well for them to kind of give us that kind of accommodation while at the same time trying to hold back inflation. Inflation's kind of ticked back up to the 3% range, which again, I don't think is the worst thing in the world. And I think the Fed's kind of coming around to that it's in a much better place than we were a year ago. That's a huge positive. And my overall thought is that the Fed's probably not going to lower rates in 2025. I think the expectations now are down to about 25 basis points of easing sometime mid-year. My thought process says that we're probably not going to see that, but that's for a good reason. The economy's putting in better results. Companies are telling us that the earnings picture as a whole is better and employment's held in. Yes, it's ticked up a little bit, but it's still right around 4%. You put all that together, there's not really a need for the Fed to be easing. Conversely, you'll hear a lot of folks say, well, maybe the Fed needs to start hiking it again to arrest, inflation, which is ticking up again. I think they're truly going to wait and see. They're going to step back. They're going to give it 3-6 months. And unless inflation ticks up to pushing 4%, I just think they stand pat. They've got a Fed funds rate right now that's 4.25% to 4.5%. I think they're very comfortable with that. It gives them plenty of juice and ammunition should the economy at some point, and it will at some point, turn down. But I just think that the Fed kind of hangs out here, and I think that's going to be really positive for the markets because the markets have already digested. We're not going to get the 100 basis points of easing. If anything, I would say markets now are probably in the camp of we don't see easing in 25. And if we do see it, it's later in the year. And as long as there's not a Fed rate hike, I think the market can kind of handle that. There will be ups and downs. There will be 3, 5, 7% pullbacks from time to time. There's a lot coming out of Washington in terms of policy, tariffs, all that stuff that will spook the markets from time to time. But overall, I really think the equity markets are conditioned to be quite content with what they're seeing now from the Fed. And then remember, Treasury market does its own work anyway. The Fed can only lead the Treasury market so much. The Treasury market's the arbiter at the end of the day of what it feels like the economy is truly up to and how it kind of reacts. So I think in that said, I really feel like a 4.5% 10-year can be managed. I think companies are very comfortable with where rates are right now. Remember, a lot of the past debt that was put on balance sheets and whatnot was done at much lower rates, and it still has maturities that are 2, 3, 4 years out. So unless we get some form of maturity cycle that, comes ahead of that, where we need to then go out, companies need to go out, or parts of the economy need to go out and float debt, I think we're in a really good spot.
Yeah, I think it's there are always things that can affect the economy. It's a question of whether or not it's an emotional reaction in the near term versus a structural issue, right? We take a hit below the waterline, so to speak. I tend to agree. It seems very unlikely that there's going to be any significant rate actions this year, one way or the other. The Federal Reserve I think they're very comfortable with where they are, to echo your point, and there's no material direction in terms of the fixed income markets. Good news is, though, stability, to add in for fixed income markets, stability is a very good thing for fixed income markets, because for the past 3 years, with rates changing violently, that's really put some red numbers on traditional rate and term fixed income, especially treasuries and the benchmark aggregate bond index. So a stable year where maybe you can clip a coupon is a very welcome year.
I love hearing you say the word stable and stability, because that's exactly, and you're the fixed income expert here, not me. I'm the equity guy. But from my perspective, that's what I think fixed income investors and market observers are looking for. If we can have that stability, all of a sudden the ag acts better. All of a sudden, various components or parts or categories within the fixed income market can kind of act like they should act given a stable environment. And I think that's a huge positive for the fixed income side.
Yeah, there's a number of reasons to buy fixed income in mass. The aggregate and fixed income investor generally likes some stability in their price. So the rest of it is coupon and cash flow, generally outside of zero coupons and stuff. But the most fixed income investors aren't gambling on price appreciation, and so yeah, absolutely, a little stability in rates that allows for a more docile, if you will, fixed income market is very welcome. So with that, right, we're in Q1. You and I tend to refer to this as rebalancing season. There's a lot of portfolio activity that'll be happening, primarily on a rebalancing level. Do you want to speak a little bit to what we're doing here and the things that people might see, the changes people might see in their portfolios?
Yeah, I mean, for the most part, it's not like we're out over our skis equity to fixed income, despite the market movements. Fixed income performing relatively well year to date has helped that. But we're like 51.5, 48.5 on our moderate expression right now. We will rebalance that back to neutral. And in doing that, that's going to provide us the ability to kind of get back to target allocations, which is something that, is important to do. It's something that we do from time to time. If we were pushed, let's say equities were at 55% and fixed was 45, we would have already done it. Anytime we get 2 or 3% above the target, we usually rebalance back. This is just the front of the year type thing that we normally do. I think it's a good time to do it. I also think it provides us the opportunity to kind of maybe from a strategic perspective, tighten the portfolio a little bit back to a strategic foundation and whatnot. Again, we're not the most tactical investors in the world. We don't claim to be. We like the strategic nature of how we've set up our portfolios and whatnot. But we get tactical when, as you say, the preponderance of the evidence presents itself. Right now, I don't see a lot of that that's necessary. We haven't had a big sell-off that we couldn't point to the reason like we saw back in COVID, where we said, this isn't right. Once the Fed comes in and backstop, we want to have equity exposures at +5 or +10% above neutral. Right now, it feels, let's get back to neutral. We know the equity market is not inexpensive. That's the one thing we're certain about. How expensive it is, that's up for debate. I would call it slightly to modestly expensive. It can go a lot higher. If I can put up a chart, Bill, I think help explain this a little bit. Let me just pull this chart up and save it, or share it, I should say. Okay, hopefully you can see that.
Yeah. Yep.
This is a chart this is from JP Morgan, the guide to the market, something that we look at quarterly, monthly, sometimes even daily. They update it daily. This is as of the end of January, so slightly dated, but the market hasn't moved a ton. I think the equities are up about 20 or 30. The S&P's up about 20 or 30 bips since then. At the end of the year, on a forward basis, a forward price to earnings, so that's the S&P 500's value divided by the earnings of the 500, which for this year are targeted at about $275. I think that number is going to end up being low, to be honest with you. But let's use the 275. We're at 21.9 times. That seems rich, but it's not that rich in an environment that we're in now where there's a lot of liquidity out there. Rates are in the 4% range. So historically, we've been a lot higher than this at certain times. And if you look back 2 years ago, we were a little bit higher than this back in late 2021. So we're not like super elevated, but we're above the average of 16.9 over the last 30 years. That includes '08 when we had a massive sell off and went sub 10 on price to equity. But nobody really truly knew what the price to earnings, but nobody truly knew what the earnings were back then. And right now, I just think, given we just had 17% year over year EPS growth for Q4, 21.9 to me doesn't seem egregious. It does seem elevated. So just arguing that we're not inexpensive, we're somewhat elevated. I would say that, this gives us an opportunity to kind of, be at equal weight in equity, no reason to be overweight, but then pick our spots where we can maybe be overweight. So one of the things we're going to do on our rebalances, we're adding a dividend portfolio where we've got the ability to kind of, very similar to what we do in our SMA dividend strategies, add a little bit of call option to the market with the dividend and with the ability for the performance of that specific that maybe soften downside should it present itself because you're protected with the dividend. So that's a call option on the market as a whole. I'll let you speak to some of the stuff that you're seeing in the fixed income side, but that's one of the areas that we're going to address on the equity side.
Yeah, I think, fixed income side, we're looking a little more intently at is rates have a bias towards stability or even potential downward. That's a positive to the ag. So we've gone back into and the ag is the Bloomberg aggregate bond index. That's the benchmark, the primary benchmark for the bond market as a whole that you see. It's similar to the S&P for equities that gets kicked around, but it's just less published and less talked about. So definitely there. Floating rate, even though there's a bias down in markets, floating rate has an extraordinary coupon right now. We're not elevating it, but we're sticking with it. We're looking at 7 to 8% yields on floating rate and bank loan instruments. Pretty extraordinary given the environment and given the durability in short coupon instruments. So those are two real interesting areas. And then as we look out longer, I would say there's a slight negative to high yield. High yield has done its job and more over the last several years. We have not really moved in this direction, but we're more interested in international markets in terms of fixed income. Not there yet. There's still a lot of uncertainty globally in pockets where you would traditionally be trafficking in Europe in some of the emerging markets. But as the tariffs play out and we start to see currencies move, there could be some opportunities there that become much more attractive, depending on the winners and the losers in the tariff scenario. The rest of the portfolio, in terms of tips and in terms of our traditional core portfolio, we're basically at neutral at this point across the board. The one change that we're going to see actually is in tips. And we continuously survey, and this is specific to our strategic asset allocation models, we continuously survey the market for similar index product at a lower cost, or even perhaps better index definitions at a similar cost. Well, in this case, we found a almost identical index expression. In this case, we're going to be replacing a State Street Spider product. with a Schwab Treasury inflation protected securities product in our portfolios and really bringing down the cost a fair amount. So the and Shawn, I don't know if you have it, but SPIP, how much was the expense ratio on that if you have it handy?
12 basis points, and it looks the Schwab product that we're adding is 3 basis points. So that's a
So,
significant reduction.
yeah. So for everybody listening, that's lingo for us. That's 0.12 down to 0.03. And so it's, in terms of the total cost, 0.12 is very inexpensive. It's 12% of 1%. But we're getting to, de minimis at 0.03. And for the same product, essentially the same product and the same exposure, we're able to reduce that cost. And we do that constantly. We're always looking for that. Last year, we replaced our floating rate fund with another floating rate fund because we liked both of the funds, but one of the funds happened to be at almost half of the cost of the other fund. And so we want to try to continually remove cost where applicable, but also maintain the quality when doing so. So anyway, Shawn, that's the fixed income report. We're happily toward neutral, and hopefully we can stay there for a good amount of.
Yeah, I agree. It feels like fixed income's, at least from a feel standpoint, in a better spot than it's been in a while. And that, like you said, that's the stability, that stable chatter that we're hearing is a real positive.
That's good.
I would also say you highlighted something really important there. We are looking to keep costs down where we can in applicable products, but that also helps to drive performance because at the end of the day, we want to make sure that, the opportunity to find lower cost funds is readily available, and it's something that we're always looking for.
That's right. So, Shawn, with that, I'm going to give you a couple of minutes. Any parting thoughts? Here we are, end of February, and any parting thoughts as we head in and start very soon the last month of the first quarter.
Yeah, the one thing, it's like the longest earnings season ever. Q4 is always the long season because companies have an extra 30 days to report. It's year end. There's a lot more there. But, we've seen really good performance as a whole. That said, there's always opportunities that arise from, certain news story or a misreading by the market of the results and whatnot. So from on the active side, that gives us an opportunity to kind of look for mispriced opportunities, we call it. Reversion to mean is always something that we're looking for. The gap, the rest of the world versus the US is has widened. So maybe that gives an opportunity for, some of our international exposure to perform better, which I think we're starting to see. And then, there's always thematic winners that come into play here. I'm not going to overbeat the AI theme because I think it's out there and around it. But I think the AI theme is much more than just that. It's power generation around AI. It's, components that are important for semiconductor companies, and it's software, and it seems to be broadening. And I think that's a really good thing for a theme to happen, is that you see this broadening out. That's a real positive. It's a real theme, and companies are investing billions and billions of dollars. Just the top 5 companies, which they call the hyperscalers, are going to invest upwards of $500 billion this year, in the AI theme as a whole. So this is a real investable theme, and it's something that we've got across all of our portfolios exposure to. We're always looking for ways that we can, accentuate the exposure and maybe find the better mousetrap, better kind of vehicle to utilize with that. And so that's something that we're always doing. But, there's a lot of opportunity in the market. I think the broadening out of the market away from just tech and a couple other sectors is a real positive. We've seen financials perform really well. I think financials set up in a stable rate environment to perform better this year. And I think some of that we're seeing right now. But I think there's a lot of different sectors that have maybe been left behind that are performing well. And as the market starts to move slightly away from tech, they'll be realized, and that could be real positives across the board.
Yeah. Thanks for that summary. And I'll throw one in for fixed income that in our separately managed accounts, a lot of people are going to see subtly, they will see AI populate that as well. We've been buying a lot of energy bonds. Energy is scarce and AI needs a lot of energy. And we've been adding quite a few energy bonds across the across that allocation in separately managed accounts. So, Shawn, with that, I'm going to finish this off with, I want to thank everybody for joining us. Hopefully there were a few nuggets in here. If there's any questions or anything, please don't hesitate to contact your advisory team. And as always, the quick disclaimer is that this is for general information purposes. Anything we talked about should not be deemed as a recommendation or a call to action. Please consult your advisory team for any of that, any specific advice on accounts or positions. So thank you, everyone, and stay safe, stay warm, and we'll see you in about a month.
Thanks, everybody. Take care.